Good morning, Liberty. It is Wednesday morning, May 29th, 2019. My name is Michael Boldin, broadcasting to you live as we do every Monday, Wednesday, Friday at 9:30 a.m. Pacific time from here in my home office and studio in downtown Los Angeles for the 10th Amendment Center. Thank you so much for joining me today. We multicast live through our channels at YouTube, Facebook, Periscope, DLive, Twitch, and of course we have archives and a podcast version over at 10thamendmentcenter.com/Good Morning Liberty. I really appreciate you spending some time with me today. In this episode, we're talking about the Federal Reserve and how it manipulates and actually wrecks the economy. Now, keep in mind, this isn't going to be a Bob Murphy, Contra Krugman, Peter Schiff, G. Edward Griffin, Ron Paul kind of expertise kind of discussion on the Federal Reserve and exactly how it works. Really what I hope to do is give you guys a good general introductory overview of how things play out. And if you want a TLDR, if you want the short version, this is it. Money printing and artificially low interest rates fuel booms, and they create all kinds of massive bubbles. Bubbles, we know, eventually pop. And then they create a crisis. And then rather than just letting that crisis play out and things fix themselves in the market economy, the Federal Reserve steps in to try to fix things for us or to put a Band-Aid over it, and it's rinse and repeat, rinse and repeat, rinse and repeat. And the boom-bust cycle is driven almost entirely, at least in modern times, it is driven by Federal Reserve policy. It's driven by government, and while a lot of people want more government to come in and fix the problems, we recognize here that you don't fix problems created by government with more government. Now, before getting to that in more detail, I do want to say hello to friends out in the live chat. Shane Lackey, I had you in mind when I thought about doing this episode on the Fed. Of course, I'm not an expert, so I'm hoping to give you guys kind of the, you're hanging out with friends and someone brings up something nutty about economic policy, and you have something good to talk to them about. So thank you, Shane, for your repeated comments over on YouTube about the Federal Reserve. Hi to Tyler B., Bob Brewer, good to see you, Bob, Ben Rippin, Larry Clark, Justin Bayola, and a few others. And then over on Facebook, Dan Reed says, never let a good crisis go to waste. No doubt about it. Hi to David Michael, Zach Blevins, Alton Smith, and everyone. I know I missed a few people scrolling through this. I do my best to keep up with the chat, but I appreciate everyone spending a little time with me today. Of course, make sure to just quickly, if you like the show, you support it, smash the like, hit subscribe, leave some comments, whether it's live or in the archive. All of these platforms are very easily triggered, so these free actions trigger their algorithms and tell them to show the program to more people. And if you're on iTunes, I'm very grateful for all the reviews that have been coming in slowly but surely. If you haven't done one of those yet, you think it's awesome, or I guess if you think it's terrible, I appreciate all the reviews and feedback. So let's get into this. I'm primarily going to be covering an article that we published recently by Mike Maharrey. And Mike is one of the lead writers, if not the lead guy, for Schiff Gold. He works for Peter Schiff's company over there. And so he's been... I remember years ago, Mike told me at one point, he's like, man, this whole Federal Reserve thing, I kept assigning him tasks to research and blog and write about. He was like, this is just a little over my head, but he's done a lot of self-learning, and I know you can do it as well, because if Mike can do it and I can learn from Mike and other people, we can read books like The Creature from Jekyll Island, we can listen to Contra Krugman, the podcast from my friends Bob Murphy and Tom Woods. You definitely don't want to miss that. Of course, Ron Paul's And the Fed book is fantastic as an introduction. So if you want to learn more, just do that. Go to the Mises Institute. Read about these things. Read about the theory of money and banking, how the government destroys the value of the money. The book by, I can't remember the exact title, but the great book from Murray Rothbard many years ago. So this is, if you want to learn in more detail, those are some things that you can do. But today I'm going to cover primarily this article and add some thoughts that Mike Maharrey wrote. Again, this is over in the show notes. If you're on YouTube, it's already there. But if you're listening later on in the archives or watching later on, you'll see them over on our website at 10thamendmentcenter.com/goodmorningliberty. how the Fed wrecks the economy. And Mike starts out pointing out that most people, when they're talking about the economy, they're just tinkering around the edges, to take a phrase from Ron Paul. They're talking about little tax cuts here and there, or maybe a little deregulation, or they're talking about, and I'm not necessarily even going to get into the corporate banks and their inflationary policy of fractional reserve banking. I'm primarily just going to focus on the Federal Reserve. They talk about deregulation and regulation, things like that. They're not really getting to the root cause of the problem. That is the Federal Reserve. And if you don't strike at the root, you're always going to be driven to the wrong solutions. And Mike goes into explaining this. He says, in practice, when the economy slows or enters into a recession, central banks like the Federal Reserve drive interest rates down and launch quantitative easing. You may have heard that phrase. I had to study it over time to understand what it means. I've got a link here that I'll cover shortly that talks about money printing and QE from the Mises Institute. So they drive interest rates down and launch QE programs to stimulate the economy. And certainly, and Mike puts it in quotes, if you're watching here on the video, you can see that, to stimulate the economy. Well, it certainly is stimulating, but it's an artificial manipulation of the economy. And maybe someone who understands the history, like what came first, the chicken or the egg? Did the Fed first start stimulating the economy, really driving this boom bust? We know in history, and Tom Woods has done at least 1 or 2 episodes on this, we know that prior to the central banking system, a boom or a bust or a recession, these were short-lived because the correction happens, and people who aren't good at managing business or money, they go out of business, and the market solves the problem. So maybe someone who understands history first can tell me the chicken or the egg down in the comments. But Mike puts it this way: when the economy slows down, they start lowering interest rates. What does that do? When you have a 0% APR credit card offer, the odds of you taking that over a 15% credit card offer is going to be more likely. A lot of people who aren't concerned about the long term will be happy, and we're just talking about consumer debt. The same thing happens on a large scale with businesses and investments. For example, there's a skyscraper bubble. I think Mark Thornton over at the Mises Institute talked about this. Maybe it was someone else over at Mises in the last few years, where if you have really cheap credit, it becomes easier if you can't buy something outright, and if you have an extremely low to no interest rate on borrowing, then of course you're more likely to take on more debt. And that's how Mike puts it in short. Low interest rates encourage borrowing and spending. The flood of cheap money, he writes, suddenly available, allows consumers to consume more. That's the stimulus. I'm not going to be very likely to run up a bunch of personal debt on 15, 20, 30% interest rate. But if I had 15% interest rate, the amount of money I'm going to sock into a bank account to sit there and just do nothing but to save is going to be, I'm going to put everything there. Well, maybe not everything in one. This is not financial advice, is what I learned from watching people who do this kind of thing on YouTube. This is not financial advice. But if I knew I was going to gain money by parking it in a bank, I'm going to save. And we know saving is the backbone of building an economy, building a strong foundation. But I'll do that. So will the big companies. So will the people who build things. They will save. They will be able to use maybe interest returns to fund research and development, for example. But when the interest rate's low, you're not going to save. You're just going to spend. There's no reason to save. There's no reason to sit on that cash. It's so easy to get more money, if another $5,000, another $10,000, whatever it may be. Mike points out this. He says it also incentivizes corporations and government entities to borrow and spend. And we know government is a whole nother level on the amount that it spends. If you're looking at a national debt, for example, around $23 trillion, which doesn't even cover everything. Someone has told me, and maybe it was Shane Lackey, that says with all the unfunded liabilities, you're talking maybe, I don't know, $100 trillion, something like that. He said, coupled with quantitative easing, there's that phrase QE, the central bank can pump billions of dollars of new money into the economy very quickly through what we know as a loose monetary policy. And again, QE is a fancy term for money printing. We often hear, and Ron Paul has said this for years, and this is where I first heard about it many years ago. They just print the money out of thin air. Now, we get pictures, and if you see the thumbnail for this episode, especially on YouTube, and you'll see it on the archives as well on our website, 10thamendmentcenter.com/Good Morning Liberty if you're not there yet. We have a roll of FRNs, Federal Reserve notes, as a piece of toilet paper. So this mentality of printing money like they have, of course they print money because if you use cash, even though they try to squeeze that out, they are printing money without a doubt. The question is, how does that happen? Do they just like getting the printing presses going? Well, in general, no. What they're doing is they're digitally creating new money out of thin air. They're adding more money into the system. And Mike says it this way: the Federal Reserve digitally creates money out of thin air and uses the new dollars to buy securities and government bonds, thereby putting cash directly into circulation. QE, quantitative easing, not only boosts the amount of money in the economy, it also has a secondary function. As the Federal Reserve buys U.S. Treasury bonds, it monetizes the government debt. Monetizing the debt. We've heard this a lot, monetizing debt. What does that mean? Well, over here at the Mises Institute, Debt and Delusion from Robert Blumen back in 2004. I'm sure they have much older ones talking about monetization. He writes, in this process called monetization, banks or the Fed, and I think this is important to point out the banks too, especially with fractional reserve banking. Fractional reserve banking is where if you take a loan or you put money in the bank, let's say you put $100 in the bank, and someone else wants a loan of $1,000, the bank only has to have a fraction in reserve cash on hand for the amount of money that it loans out. I believe the number is 10%. It might be different, but let's say it's 10%. So for every $1,000 it loans out, it only needs $100 on hand. So you're creating money out of thin air on the bank-to-bank level, not just at the Federal Reserve level, too. And so that's important to understand a little bit further. Maybe I can get into that in a little bit more detail on another show if you guys are really interested. But that's the short version. So in this process called monetization, banks or the Fed create the money out of nothing with which to purchase the bonds. This is often referred to as printing money, although in modern times, the money is usually created electronically rather than through the manufacture of paper notes. And this is the reference note here is to another book. This is the book I was trying to think of. Murray Rothbard, The Mystery of Banking. He explains this whole process in detail on pages 105 to 108. I'm assuming that the Mises Institute, yeah, they have this available for free. It was written in 1983. This is a great book to read to understand this process in more detail if you're craving more information. Justin Bayola, thank you for the heads up on that. That 10% is correct on the fractional reserve. So every time they're loaning out money, there's more money into the system. And if you think about how that plays out, let's say there's a fixed amount of money. And for those of you who are commenting, talking about gold and silver, sound money, constitutional money, constitutional tender. While there isn't a 100% fixed supply, and I think that's where cryptocurrency, Bitcoin advocates are very strong. They say the math, which I don't understand, the math means there's going to be a fixed supply, it can never increase. As long as the supply can barely increase, and I think gold and silver is a good example of that, then you know how much things are going to cost in general, and less labor costs, or you have to use more labor or investment to build something. So all things being equal, this water bottle, I guess we'll call it, let's say it's $2. There's $100 available, and there's 50 people who want to buy it. And we'll see if this is a good analogy. Now, all of a sudden, there's $1,000 available and 50 people who want to buy it. Well, the odds are someone's going to bid the price up because they have more cash on hand. And this could bid the price up as much as 10 times. Who knows? Depends what the market has to say about it. But having the extra cash on hand actually encourages the cost to go up. And inflation, while we always want to think of as price increase, inflation, a real understanding of inflation is a devaluing in the currency. The currency is valued less, and it requires more of the currency, more dollars, to chase the same amount of goods. So getting back to Mike's article here, we're talking about, again, monetizing the debt. So first of all, we've got low interest rates. This encourages people to borrow and spend, and it disincentivizes savings. Then on top of it, the government goes through, or the Federal Reserve goes through QE. They print money out of thin air. Then they buy debt with this money that's printed out of thin air. Now, in QE1 back in 2008, they also buy financial instruments. They did this with mortgage-backed securities, and this served as a bank bailout. So they're creating money out of thin air to prop up favored businesses or favored industries that happen to maybe do some donation or work with the system to the political system. They participate in this, and they keep them afloat when they should be going out of business. So General Motors should be out of business. I don't know, should Citibank, Bank of America, they have bad business practices. Of course, it's encouraged by the system at hand. But when the bubbles pop, you have to clear out what we would call malinvestment. If you listen to the Peter Schiff show, his podcast, you'll hear him talking about malinvestment. Because when credit is cheap, money is cheap, and you invest in these products, or you invest in building skyscrapers like we see here in downtown Los Angeles from 2008, there were tons of projects that were kind of slated to go, and then when it popped, then those things went out of business. Now, because the Federal Reserve goes in and injects more cheap money into the system again, then those projects start moving forward. Eventually, this all has to clear out. So the monetary policy of the low interest rates and the extra money creates a boom, but it is temporary. All the new money has to go somewhere, Mike writes. It could result in rising consumer prices, and he calls that inflation. I tend to call, you could say it's price inflation, but real inflation is a devaluing of the actual currency. But generally, it pumps up the price of assets such as real estate and stock markets, creating a fake wealth effect. People feel like they're wealthier because they have more money. Oh, I should get back to the article here so you guys can see what I'm going through. They feel wealthier because you have more cash. But if the cash buys less stuff, what does it matter? So someone who maybe, I have a friend who bought a condo here in downtown Los Angeles, a 2-bedroom, 2-bath, high-rise condo for like $170,000 in the early 90s. And it's probably, I can't even imagine. This has got to be worth $1 million easily? $1.5 million? Even in an old, not remodeled building? Well, old. I guess that all depends how you look at it. $1 million and a half. And I said, oh, man, you should sell this. I said to him a few years ago. He's like, well, what would I do with it? If I went and bought something else, I would and want to live where I live, I'm going to have to spend all that money, if not more. I actually haven't gained any wealth at all. I've just gained in value. It's a paper wealth. And so people tend to see that. They see the prices driving up, and they think that the prices going up will never stop. Now, Mike points out that the process also creates inequality. People on the left, we hear them talk about the 99% or the 1% versus the 99%. It's the rich people who are bad, the corporations who are bad. Of course, they rarely talk about government being bad unless they don't like the person in charge, which means they're just not smart because they're missing the big picture and the long game. But it creates inequality. And this is how Mike puts it. The first receivers of this new money, generally bankers and politically connected individuals and institutions, get the most direct benefit from the newly minted dollars. Their decisions on where to spend the money create artificially high demand in the chosen industries or asset classes. Think the housing market. So the rich people, if you flood a bunch of money out there, you bail out a banking system or an industry, they have a bunch of cash on it, they can actually drive the money that they have on hand towards specific industries. And Mike gives the housing market leading up to 2008, or tech companies during the dot-com boom back in like the late 90s up until about 2000. And Mike goes on, meanwhile, surging economic growth, shrinking unemployment, and rising stock markets driven by money creation give the illusion of a healthy economy, but the monetary policy hides the economic rot and the foundation. Again, it's a fake boom. Now, Donald Trump, not to talk too current events, when he was a candidate, he talked about the Fed being a problem because it was creating a boom. Now you hear him talk about the boom, the greatest economy we've ever known. And this is politician talk. Of course, when the stock market is up and the press, online and otherwise, are talking about how people are getting rich, and of course it's usually just the richest of the rich getting richer, while the average people who aren't even allowed to invest a lot of times, you're not an accredited investor, you can't get in on the ground floor, so you're not making money. I'm not making money on this, but there are certain people that are making a ton of money. But we're sold this bill of goods that everyone's getting loaded. And then of course by the time the money trickles down to the rest of us, when we start making dumb decisions and buying all kinds of stuff on all kinds of credit that we can't actually afford, we're getting much closer to the bubble pricking, popping. Now, sometimes this can be caused by the Federal Reserve. The Federal Reserve may start raising interest rates because, of course, it recognizes that if you keep this boom going, you keep driving things up, inflation keeps getting higher and higher, eventually people are going to complain about this. This is going to create some other problems. So people then believe that there's an economic recovery because of all this stimulus. And Mike points out that once this apparent recovery, again, it's fake, it's on paper, the Fed tightens its monetary policy. This is opposite of QE. It tends to end those programs. It stops creating new money. It stops buying debt, and then nudges interest rates back up. It starts moving the interest rates higher. But all the people who took on debt, individuals, businesses, mega corporations, if you take on debt and then the interest rate goes up, because usually it's a variable interest rate unless you're rich enough to be able to negotiate deals that survive this type of thing, eventually that debt starts costing too much. And it's a very tricky balance. And I don't know if the Federal Reserve is really just trying to dance around this, recognizing that it's not necessarily easy to figure out. I mean, the market would tell us what the real interest rate would be. But when they start raising from 0 to 0.25 to 0.75 to 1, then that costs a lot. When you're talking about billions, if not trillions of dollars of debt, that adds a lot of load to the system. Mike goes on. He says, when the recovery appears to be in full swing, the central bank may even shift to quantitative tightening, shrinking its balance sheet. During the boom, governments, consumers, and companies pile up enormous amounts of debt. Rising interest rates increase the cost of servicing that debt. They also discourage new borrowing. Easy money dries up. This speeds up the onset of the next recession, and the cycle repeats itself. Now, it isn't always necessarily caused by the Fed trying to normalize the economy. I believe sometimes this just happens. Sooner or later, a bubble gets so big, it's just going to pop out of nowhere. No one's expecting it except the few people that study Austrian economics. They're warning about it for year. But if you even have listened to the best of the best, they tell you something's going to pop. When Peter Schiff was right about the 2008 situation, it's not that he knew it was going to happen in 2008, but for years he told us that this type of policy is going to lead to a crash, which of course it did. And so in Mike's article here, again, over at 10thamendmentcenter.com/goodmorningliberty, we also sent this out as an email blast. If you're on our email list and you get our newsletters, we send out the entire article for you to check out there so you can read it easily on the go. He goes over 3 times this happened, how this played out. October 87, December 96, and then, of course, the 2008 financial crisis. I think it's really interesting stuff if you want to read in a little bit more detail. But really, in summary, this is what we're talking about. In summary, when we're talking about the Federal Reserve and how it creates boom-bust cycles, this is how it goes. Low interest rates, they encourage borrowing and spending instead of savings. Then they do money printing. This is QE. This floods the economy with more cash. This is inflation because the money is worth less. You have more dollars chasing the same amount of products. But we know that things that can't go on forever don't. Eventually they end. And eventually these bubbles form and they pop. They form due to the borrowing and spending, malinvestment driven by low interest rates, and the inflation. And what happens to bubbles? Eventually they pop. And then rather than letting the crash play out, letting the market figure out where things are supposed to go, letting the bad actors in the economy, the ones who don't know what they're doing, who make bad choices, go out of business, because when you're free to make errors and go bankrupt. Rather than letting people go out of business, go bankrupt, the Fed comes in to fix everything. They don't let it play out, and then they start the process over and over again. They come in to fix things, solve one crisis, they create a new boom-bust cycle repeatedly. So I don't know. I think this is the general introductory explanation to it. Of course, as I mentioned at the beginning of the show, there's a lot more detailed places. Of course, mystery of banking, how government destroys the economy, ruins our money, something like that is another Murray Rothbard book. Of course, if you want to listen to podcasts, Contra Krugman again, reading over at Mises.org. I think Debt and Illusion, this article over at Mises that I included in the show notes, is a really good one. But let's take a look over at the live chat. Eric Nance says a regulated currency is a stable, non-inflationary or deflationary currency, not an artificially manipulated and arbitrarily controlled one. And that's really what we have on this. It is manipulated and controlled by the central bank. Taking a look. R.C. Andrews. Jay Armstrong says there is nothing federal. There are no reserves, and it's not a band. It's not even fractional reserve loaning. It's counterfeiting. That's actually a pretty good way to put it. Gold Standard with Alan Mosley. Make sure to check out his show as well, also on YouTube and Facebook, I believe. I could use them moving a few of those decimal points my way, but I'm not in the political class who will benefit from the windfall before the value of the dollar corrects downward. Absolutely. It really is. It's a scratch my back and I'll scratch yours type of a situation there between the banks. And of course, the banks are part of this problem too. Shane Lackey talks about how this creates a loss of purchasing power. 2% annual loss baked into the cake. From my understanding, the purchasing power of the dollar since 1913, a really bad year, taxation, income tax, Federal Reserve, etc. The purchasing power of the dollar has gone down somewhere around 94, 96%. Someone correct me in the show notes on the right number. Of course, Hyde EHP training. Glad you made it, even though late. It's cool. We can always back up and watch the archives, too. And Justin Bayola points out that the cycles are a direct profit grab by the bank. I think you're onto something with that. So, again, I hope you guys find this interesting. It's useful, educational, fun to watch, listen to, all that good stuff. A reminder, if you like this kind of information, you like this show, you want to help me get the word out, smash the like, hit subscribe, continue leaving some comments, whether it's here live or in the archives. It doesn't matter. It triggers all the platforms to show the program to more people. I'm grateful for the reviews people have been leaving on iTunes. Thank you very much. All of our archives are over at 10thamendmentcenter.com/goodmorningliberty. And what else was I going to say? Oh, yeah. If you want to give us some cash, Don't feel any obligation to do so, but 10thamendmentcenter.com/donate. You can pitch in if it's $1 or $1,000, whatever it may be. We do take Federal Reserve notes as long as we can continue spending them to keep our infrastructure strong, keep the lights on, keep doing this show, reach new people. We'll do some ad campaigns from time to time as well to start putting this program and our articles and website in front of more new eyes. So all that helps out a lot. Or, of course, if you want to become a member, it's 10thamendmentcenter.com/members. Anyways, I appreciate you all joining me today. I'll see you on Friday. And, of course, next week, Monday, Wednesday, Friday, 9:30 a.m. Pacific time. Have a great day and awesome. We'll see you next time.